The story of Henry Kravis, the architect of modern private equity. January 6, 1944. A baby boy is born in Tulsa, Oklahoma, into a world at war. American forces are fighting across two oceans. The economy is fully mobilized for the war effort. Factories run around the clock producing tanks, planes, and ships. Women have entered the workforce in unprecedented numbers. Rationing is standard practice. The stock market is recovering from the Depression lows but remains below its 1929 peak. This is the America that welcomes Henry Kravis. His timing is impeccable. He arrives just as the greatest economic expansion in American history is about to begin. The post-war boom will create opportunities his generation would seize. But more importantly, he is born into exactly the right family in exactly the right place at exactly the right time to revolutionize American business. The Kravis family story is one of American upward mobility. Henry's father, Raymond Kravis, was born in Atlantic City, New Jersey in 1913. Raymond came from modest means but possessed fierce ambition and uncommon intelligence. He attended Lehigh University, graduating in the 1930s during the depths of the Depression. While many of his classmates struggled to find work, Raymond demonstrated an early talent for finance and business. Raymond Kravis moved to Tulsa, Oklahoma, a booming oil town in the 1930s. Tulsa was unlike anywhere else in America at that time. Oil had been discovered in Oklahoma in the early 1900s, and by the 1930s, Tulsa called itself the oil capital of the world. Millionaires were being made overnight. The city had more millionaires per capita than any other American city. Downtown Tulsa featured Art Deco skyscrapers rivaling those of much larger cities. The Boston Avenue Methodist Church, completed in 1929, stood as a testament to the city's oil wealth. This was the perfect environment for an ambitious young man with financial acumen. Raymond Kravis quickly established himself in Tulsa's business community. He founded an oil and gas trading business, leveraging relationships and market knowledge to build a successful enterprise. But Raymond's real genius was in investment partnerships. He became a pioneer in creating private investment vehicles that pooled capital from wealthy individuals to invest in oil and gas properties. Raymond Kravis was doing in the 1940s and 1950s what would later become formalized as private equity. He raised money from limited partners, identified undervalued oil properties, acquired them, improved operations, and sold them at a profit. He charged management fees and took a share of the profits. Sound familiar? This is the exact model his son Henry would later apply to corporate America and turn into a multi-trillion-dollar industry. But Raymond was more than just a deal maker. He was a relationship builder, a trusted advisor to some of Tulsa's wealthiest families. People gave him their money because they trusted his judgment and integrity. He operated on a handshake. His word was his bond. These were not just business principles. These were moral imperatives instilled by his own upbringing and reinforced by the tight-knit Tulsa business community where reputation mattered more than written contracts. Henry's mother, Bessie Roberts Kravis, came from a prominent Tulsa family. The Roberts family had deep roots in Oklahoma, and Bessie brought social standing and connections that complemented Raymond's business acumen. She was educated, cultured, and instilled in her children the importance of education, manners, and social responsibility. The Kravis household was one where business was discussed at the dinner table, where success was expected, and where relationships mattered as much as results. Henry grew up in this environment of wealth, ambition, and deal-making. The family lived in one of Tulsa's finest neighborhoods. They belonged to the right clubs. They knew the right people. But this wasn't idle wealth. Raymond Kravis worked constantly, always pursuing the next opportunity, always building relationships, always thinking about how to create value. Young Henry watched and absorbed everything. Henry had one sibling, George Kravis, who was older by several years. George was brilliant and attended Yale before joining the family business. The dynamic between the brothers would later become important, as George would eventually work alongside Henry and his cousin at KKR, though George would ultimately take a different path. Growing up, Henry was the younger brother, always trying to keep up, always trying to prove himself, always competing for attention and approval. The Kravis family was upper middle class verging on wealthy, but they were not among Tulsa's true oil barons. They were comfortable, very comfortable, but Henry grew up around people who were vastly wealthier. He saw the private planes, the multiple homes, the lifestyle that serious wealth afforded. This created both aspiration and a slight sense of being outside looking in. Henry wanted to be one of those people at the very top, not just comfortably well off. Tulsa in the 1950s was a unique place. It was a mid-sized city with big city wealth. The cultural scene was surprisingly sophisticated for a city of its size, funded by oil money. The Philbrook Museum, housed in an oil baron's mansion, featured world-class art. The city had a thriving downtown, excellent schools, and a business community that punched above its weight. Everyone who mattered knew everyone else. Deals were done at the Tulsa Club. Fortunes rose and fell with oil prices. It was capitalism in its most raw and dynamic form. This environment shaped Henry profoundly. He learned that money was the scorecard, that relationships opened doors, that opportunities came to those who were prepared, and that the biggest fortunes came from buying assets others had given up on. He learned that oil properties were just assets that could be analyzed, improved, and sold. This would later translate perfectly to companies. A struggling company was just like an underperforming oil field. Both could be turned around with the right capital, management, and operational improvements. Henry attended Tulsa's best schools, where he was a good but not exceptional student. He was smart enough but not the smartest in his class. What distinguished Henry was his drive and his social intelligence. He understood people. He knew how to read a room. He knew when to push and when to pull back. He knew how to make people like him and trust him. These were skills learned at home, watching his father work a room at the Tulsa Club, observing how deals were really done through relationships and trust. Young Henry also showed early signs of the competitiveness that would define his career. He played sports, not with exceptional natural ability but with fierce determination. He hated losing more than he loved winning. This trait, the absolute refusal to accept defeat, would become central to his identity. In business, this meant never giving up on a deal, never accepting no as a final answer, and always finding a way to win. The formative event of Henry's youth was watching his father operate. Raymond would take Henry to meetings, let him sit quietly in the corner, and afterwards explain what had happened and why. Raymond was teaching his son the art of the deal before anyone had written books about it. Henry learned that everyone has motivations, that understanding what the other party needs is the key to structuring deals, that there's always more than one way to solve a problem, and that creativity in deal structure often matters more than the raw numbers. But Raymond also taught integrity. He once told Henry about walking away from a deal that would have made him a fortune because something didn't smell right. 6 months later, the deal blew up in scandal. Raymond's lesson: trust your instincts, protect your reputation above all, and remember that you only get one reputation and it takes a lifetime to build but minutes to destroy. This lesson would stay with Henry throughout his career, even during the controversial battles of the 1980s. Henry attended Eagle Brook School in Massachusetts for middle school, one of the elite prep schools that fed into top Northeastern prep schools and Ivy League universities. This was Henry's first extended time away from Tulsa, his first exposure to real East Coast wealth and power. The kids at Eagle Brook came from America's wealthiest families. Some were heirs to industrial fortunes, others to banking dynasties. This was old money, not the relatively new oil money of Tulsa. Henry felt like an outsider at first. He was from Oklahoma, which to these East Coast kids might as well have been another country. He had a slight southwestern accent. He didn't have the same cultural references. But Henry had something many of these kids lacked: hunger. They were comfortable with their inherited positions. Henry wanted to prove himself. This outsider status, this sense of having to earn respect rather than inheriting it, became a powerful motivator. At Eagle Brook, Henry learned to navigate elite East Coast society. He learned the codes, the unwritten rules, the way these families thought about money, legacy, and status. He learned that to them, business was almost beneath discussion, handled by managers while they focused on boards, philanthropy, and leisure. This was completely foreign to Henry, whose father lived and breathed business. But Henry filed away this knowledge. He learned to speak their language while maintaining his own values and work ethic. Henry then attended Loomis School, another elite Connecticut prep school, for high school. By this time, he had figured out how to succeed in this world. He was popular, well-liked, a solid student who excelled in the subjects that interested him and did enough in the others. He dated, played sports, and positioned himself within the social hierarchy. More importantly, he began to develop the network that would later prove invaluable. The boys he met at Loomis would go on to run companies, manage fortunes, and sit on boards. These relationships, formed as teenagers, would matter decades later. A pivotal moment came during a summer break when Henry worked in his father's office. He was 16 years old, and Raymond put him to work analyzing potential oil investments. Henry discovered he loved it. The research, the analysis, figuring out what something was really worth versus what people thought it was worth, finding the opportunity others missed. This was a puzzle he enjoyed solving. More than that, he was good at it. Raymond noticed his son's aptitude and began giving him more responsibility. That summer, Henry worked on a deal with his father to acquire a small oil field that had been producing for years but was now considered largely depleted. The owner wanted to retire and was willing to sell cheap. Raymond and Henry studied the field's production data and geology reports. Henry spent hours in the office poring over technical documents he barely understood at first. But with his father's guidance, he began to see the opportunity. The field wasn't depleted. It had been poorly managed. With new drilling technology and better extraction methods, there was significant remaining value. Raymond bought the field, applied the improvements, and within 2 years sold it for 3 times what he paid. Henry watched this entire process unfold. He saw how his father identified the opportunity, structured the financing, managed the operations, and executed the sale. This was the model that would define Henry's career, just applied to companies instead of oil fields. Find an undervalued asset others have given up on, acquire it at a good price, improve operations, and sell at a significant profit. Henry graduated from Loomis in 1963 and enrolled at Claremont McKenna College in California. This choice was unusual for someone from his background. Most of his prep school classmates went to Ivy League schools in the Northeast. Harvard, Yale, Princeton, that was the expected path. But Henry wanted something different. He wanted to go west, to California, which in the early 1960s was emerging as a center of innovation and new wealth. The California economy was booming with aerospace, technology, and real estate. This was where the future was being built. Claremont McKenna was a small liberal arts college with a strong focus on economics, government, and public affairs. The student body was small, around 600 students, which meant Henry stood out. He couldn't hide in the back of a lecture hall. Professors knew him by name. This intimate environment suited Henry perfectly. He thrived on personal relationships and individual attention. He majored in economics, studying under professors who emphasized free markets, entrepreneurship, and the role of capital in economic growth. The early 1960s were a transformative time in America. The post-war economic boom continued. The stock market was strong. Kennedy was president, bringing a sense of youthful energy and optimism. Civil rights were becoming a major issue. The Vietnam War was escalating. Students were becoming politically active. But Henry remained largely apolitical, focused on business and economics. His interest was in how things worked, how deals were structured, how value was created. Politics seemed like a distraction from the real action, which happened in markets and boardrooms. During his college years, Henry spent summers working in finance. After his sophomore year, he secured an internship at a small investment bank in Los Angeles. This was his first exposure to Wall Street-style finance, and he was fascinated. The pace, the sophistication, the size of the deals compared to his father's oil investments. Investment bankers were advising companies on mergers, acquisitions, and financing. They were at the center of American capitalism. Henry decided this was where he wanted to be. But there was something missing from traditional investment banking. The bankers advised on deals but didn't own the assets. They collected fees but didn't participate in the upside if the deal worked out brilliantly. They were highly paid intermediaries, but they weren't principals. Henry remembered his father's model, where Raymond invested his own money and his investors' money, taking significant risk but capturing significant reward. Henry wanted to combine the sophistication of Wall Street with the principal investing model his father had pioneered. Henry graduated from Claremont McKenna in 1967. The country was changing rapidly. The Summer of Love was happening in San Francisco. Anti-war protests were intensifying. The civil rights movement was gaining momentum. But Henry was focused on his next step. He applied to business school, specifically to Columbia Business School in New York City. Columbia had a strong finance program and was located in the heart of the financial world. More importantly, Columbia had a professor named George Roberts who was doing pioneering work in corporate finance and valuation. Wait, let me correct that. The George Roberts who would become Henry's partner and cousin was not his professor. That's getting ahead of the story. At Columbia, Henry studied under professors who were developing modern corporate finance theory. This was a revolutionary time in academic finance. Professors were creating frameworks for valuing companies, analyzing capital structure, and understanding risk and return. The efficient market hypothesis was being developed. The capital asset pricing model was emerging. Corporate finance was becoming a rigorous discipline. Henry absorbed this academic knowledge but always filtered it through his practical experience with his father. The professors talked about efficient markets where all information was reflected in prices. Henry knew from watching his father that markets were often inefficient, that information was asymmetric, and that smart investors with better information and analysis could consistently outperform. The academic theory provided useful tools, but real-world experience provided wisdom about when and how to apply those tools. During his first year at Columbia, something happened that would change Henry's life. He met Jerome Kohlberg Jr. Jerry Kohlberg was a banker at Bear Stearns who occasionally guest lectured at Columbia. Kohlberg was in his early 40s, already a successful investment banker, but he was thinking about a new approach to investing. He had been doing small deals at Bear Stearns where the bank would provide financing to help management teams buy their own companies. These were called management buyouts. The idea was elegant. Many companies had divisions or subsidiaries that the parent company no longer valued or wanted. Sometimes these were mature businesses that weren't growing fast enough. Sometimes they were tangential to the parent's core strategy. Often they were perfectly good businesses that were simply undervalued and underloved within a large corporation. Kohlberg realized that if you could buy these businesses at low prices, using significant amounts of borrowed money, and then improve operations with motivated management, you could generate extraordinary returns. The key insight was leverage. If you bought a business for $100 million and put up $10 million of equity and borrowed $90 million, and then through operational improvements and growth you sold it 5 years later for $150 million, you didn't just make 50% on the purchase price. You made 5 times your equity investment, a 500% return. The borrowed money magnified returns. Of course, it also magnified risk. If the business struggled, the debt burden could crush it. But with the right businesses and the right operational improvements, the returns could be spectacular. Kohlberg came to Columbia and explained this model to a small group of students. Henry sat in the audience transfixed. This was exactly what his father had been doing with oil fields. Buying undervalued assets with leverage, improving them, and selling at a profit. But Kohlberg was applying it to entire companies. The potential was vastly larger. Oil fields were limited by geology. Companies were limited only by management and capital. Henry approached Kohlberg after the lecture and introduced himself, explaining his father's work in Tulsa. Kohlberg immediately saw the connection and was impressed that this young student understood the model intuitively. They began talking regularly. Kohlberg became an informal mentor to Henry. He explained how the deals were structured at Bear Stearns, the types of companies that work best, the importance of management quality, and the challenges of the highly leveraged structures they were using. Henry soaked it all up like a sponge. He asked smart questions that revealed his grasp of the fundamentals. Kohlberg began to think this young man might be someone he could work with in the future. Henry graduated from Columbia Business School in 1969. The economy was strong but showing signs of strain. Inflation was beginning to tick up. The Vietnam War was draining resources. The stock market had peaked and was becoming volatile. The Nifty 50 stocks of the go-go years were starting to look overvalued. But for a young MBA with energy and connections, opportunities abounded. Henry had multiple job offers from major investment banks and corporations. The expected path was to join Goldman Sachs or Morgan Stanley or one of the other white shoe firms. But Henry didn't take the expected path. Jerry Kohlberg offered him a job at Bear Stearns working in the corporate finance department on management buyouts. The salary was modest by investment banking standards. Bear Stearns was not one of the most prestigious firms. It was known as a scrappy, aggressive shop that took risks the blue-chip firms avoided. The culture was rough around the edges, meritocratic, and intensely competitive. You succeeded based on what you produced, not your pedigree. This suited Henry perfectly. Henry joined Bear Stearns in 1969 at age 25. He was assigned to work directly with Jerry Kohlberg on management buyout transactions. This was an incredibly fortunate placement. Most young associates spent years doing grunt work before getting near real deals. Henry was immediately involved in sourcing, analyzing, and executing actual buyout transactions. Kohlberg saw Henry's potential and gave him responsibility quickly. If Henry performed, he would be rewarded with more opportunity. If he failed, he would be out. It was that simple. The work was grueling. Investment banking in 1969 was not the polished, process-driven industry it would later become. There were no spreadsheet programs. All financial analysis was done by hand or on mechanical calculators. Late nights were spent with legal pads and adding machines, building financial models to determine what a company might be worth under different scenarios. Henry would build model after model, testing assumptions, looking for the deal that made sense. Bear Stearns' approach to management buyouts was straightforward. They would identify a corporate division or subsidiary that seemed undervalued or unwanted. They would approach the management team running that division and ask if they would be interested in buying the business from their corporate parent. If management was interested, Bear Stearns would help structure the deal, providing some of the equity capital and arranging bank debt to finance most of the purchase price. The management team would put in some of their own money to ensure they had skin in the game. Henry quickly distinguished himself in several ways. First, he had a gift for building relationships with management teams. He could sit down with a factory manager or division president and quickly establish rapport and trust. These were not Wall Street sophisticates. They were operators, engineers, and salespeople who had spent their careers building businesses. Henry spoke their language. He asked about operations, customers, and competition, not just financial returns. Management teams liked him and trusted him. Second, Henry had inherited his father's ability to see value others missed. He would study a business and identify the specific operational improvements that would drive value creation. Maybe they needed to consolidate facilities. Maybe they could renegotiate supplier contracts. Maybe the product line could be rationalized. Henry thought like an owner, not a financial analyst. He wanted to understand how the business actually made money and how it could make more. Third, Henry was willing to work harder than anyone else. He would fly to visit a potential acquisition, spend the entire day in meetings, take the red-eye flight back to New York, and be at his desk by 8 in the morning ready to start calling banks to arrange financing. His colleagues noticed that Henry never seemed to tire, never complained, and never gave up on a deal he believed in. This work ethic became legendary. In 1969 and 1970, Henry worked on several small management buyouts with Kohlberg. These were not huge deals by later standards, companies worth $5 to $20 million. But they were learning experiences. Henry learned how to structure deals to minimize equity and maximize leverage. He learned how to negotiate with banks for financing. He learned how to work with management teams to develop operational improvement plans. He learned how to deal with corporate sellers who often didn't care much about the price as long as they could get a division off their books. One early deal exemplified the model. A large conglomerate wanted to sell a small manufacturing business that made industrial components. The division was profitable but growing slowly. The conglomerate was focused on higher growth businesses and viewed this mature operation as a distraction. The division president was a 50-year-old engineer who had built the business over 20 years but was frustrated by corporate bureaucracy and lack of investment. Henry and Kohlberg approached the division president and asked if he would be interested in buying the business. The president was intrigued but skeptical. How could he possibly afford it? He made a good salary but had nowhere near the millions required to buy the division. Henry explained the structure. Bear Stearns would provide most of the equity. Banks would lend most of the purchase price based on the business's cash flow and assets. The president would need to invest perhaps $100,000, a significant sum but manageable if he mortgaged his house and used his savings. The division president was concerned about the risk. If the business struggled, he could lose everything: his job, his investment, his house. Henry acknowledged the risk but walked through the upside. If they could grow revenue just 5% a year and improve margin slightly through better purchasing and efficiency, in 5 years the business could be worth 3 times what they paid. The president's $100,000 investment could become $3 million. This was life-changing wealth, the opportunity to become genuinely rich rather than just well-paid. The president agreed. Bear Stearns structured the deal, buying the division for $10 million with $2 million of equity and $8 million of bank debt. The president invested $100,000, Bear Stearns and other investors put in the rest of the equity. Over the next 5 years, the president ran the business aggressively. Freed from corporate constraints, he made decisions quickly. He invested in new equipment to improve efficiency. He closed an underperforming facility and consolidated production. He renegotiated supplier contracts, saving hundreds of thousands annually. The business flourished. Revenue grew faster than projected. Margins improved significantly. By year 5, the bank debt had been paid down from cash flow. The business was worth $35 million. Bear Stearns and its investors sold to another company. After paying off remaining debt and transaction costs, there was $30 million in proceeds. The equity investors, who had put in $2 million, received $30 million, a 15-fold return. The division president's $100,000 had become $1.5 million. He was wealthy, truly wealthy, for the first time in his life. Henry had orchestrated this transaction from start to finish. He had found the opportunity, convinced the management team, structured the deal, arranged the financing, and worked with the president throughout the holding period. This single transaction validated everything Kohlberg had taught him and everything Henry had learned from his father. The model worked. Buying good businesses at reasonable prices with leverage, improving operations, and selling at significant profits could generate extraordinary returns. Between 1969 and 1975, Henry worked on dozens of these management buyouts at Bear Stearns. Each deal refined his understanding of what worked and what didn't. He learned that management quality mattered more than almost anything else. A great management team could overcome challenges and create value even in difficult industries. A weak management team would struggle even with advantages. He learned that businesses with stable cash flows were essential when using high leverage. Cyclical businesses or those dependent on one customer were too risky. He learned that operational improvements had to be specific and achievable, not vague hopes that things would get better. During these early years at Bear Stearns, Henry also learned the importance of relationships with bankers. The entire model depended on borrowing large amounts of money to finance acquisitions. In the early 1970s, most commercial banks were conservative and skeptical of highly leveraged transactions. They viewed debt as something to be used sparingly and paid back quickly. The idea of loading a company with debt equal to 4 or 5 times its annual earnings made them nervous. Henry had to educate bankers, show them that with the right businesses and structures, these loans were actually quite safe. Henry developed relationships with lending officers at major banks. He took them to dinner, spent time explaining the deals, showed them the track record of successful transactions, and gradually built trust. These bankers began to realize that Henry and Kohlberg were serious professionals who understood credit risk. They weren't gambling with the bank's money. They were careful, analytical, and conservative in their own way. They only did deals where they were confident the business could support the debt. Over time, banks became more comfortable lending to buyout transactions, which would prove crucial to the industry's growth. In 1972, something significant happened at Bear Stearns. Henry's cousin, George Roberts, joined the firm. George Roberts was the son of Henry's mother's sister. George had grown up in Houston, another oil city, where his father was also in the oil business. George and Henry were close in age and had known each other their whole lives. They had spent summers together, gone to family gatherings, and stayed in touch through college. George had attended Culver Military Academy and then Claremont McKenna, the same college Henry had attended. After graduating, George went to law school at Hastings in San Francisco, but after 1 year he realized law wasn't for him. He wanted to be in business. George called his cousin Henry and asked about opportunities at Bear Stearns. Henry talked to Kohlberg, who agreed to interview George. Kohlberg was impressed. George had many of the same qualities as Henry. He was smart, personable, and hardworking. He understood business from growing up in an entrepreneurial family. Most importantly, the chemistry between Henry and George was obvious. They thought alike, finished each other's sentences, and had an easy rapport. Kohlberg decided to hire George, thinking that the cousin team might work well together. George Roberts joined the buyout group at Bear Stearns and immediately proved his value. He had a slightly different skill set than Henry. While Henry excelled at relationships with management teams and operational thinking, George was exceptional at the financial and legal structuring of deals. He had a lawyer's attention to detail and ability to think through complex contractual arrangements. He also had a calm, steady demeanor that balanced Henry's intensity. Together, Henry and George became a formidable team, more effective than the sum of their individual contributions. Jerry Kohlberg watched the cousins work together and recognized something special. They had complementary skills, absolute trust in each other, and shared values rooted in their similar upbringings. They both believed in building relationships, operating with integrity, and creating value through hard work rather than financial engineering. They both had grown up around entrepreneurial fathers and understood principal investing. Kohlberg began to think about the future. He was in his late 40s now, and he wondered if these two young men might be his successors, his legacy. Through the early 1970s, the management buyout business grew at Bear Stearns, but it remained a small part of the firm's overall operations. Bear Stearns made most of its money from trading and traditional investment banking. The buyout transactions were interesting but not materially important to the firm's bottom line. This created tension. Kohlberg, Henry, and George were building something valuable, but they had limited resources and limited support from senior management. They began to feel constrained. The broader economic environment in the mid-1970s was challenging. The oil crisis of 1973 sent shockwaves through the global economy. Oil prices quadrupled almost overnight. Gas lines formed at service stations. Inflation spiked. The stock market crashed, falling nearly 50% from 1973 to 1974. The Watergate scandal and Nixon's resignation created political uncertainty. The economy slipped into recession. Unemployment rose. Consumer confidence plummeted. This was the worst economic environment since the 1930s. But Henry and George saw opportunity in crisis. While everyone else was paralyzed by fear, they recognized that corporate divestitures would increase. Companies under financial pressure would sell divisions to raise cash. Valuations were low because buyers were scarce. Competition for deals was minimal because most investors were hiding under their desks. This was the perfect time to be aggressive. They approached Kohlberg with a proposal. They should raise a fund dedicated to management buyouts, allowing them to move quickly when opportunities arose. Kohlberg was receptive but cautious. Bear Stearns would need to approve such a fund, and the firm's management was risk-averse in the current environment. Nevertheless, Kohlberg, Henry, and George put together a proposal. They would raise a small fund, perhaps $30 to $50 million, from wealthy individuals and institutions. The fund would invest in management buyouts of mature, cash-generating businesses. The investment strategy was conservative despite the leverage. They would focus on businesses with stable earnings, strong market positions, and experienced management teams. Bear Stearns' management was skeptical. Why would wealthy investors give money to do these risky, leveraged buyouts in the middle of a recession? But Kohlberg leveraged his relationships with Bear Stearns' clients, and Henry and George began calling potential investors. They spoke to wealthy families they had worked with, to pension funds that were looking for higher returns, and to insurance companies with long-term capital to invest. The pitch was simple. Traditional investments were struggling. The stock market was down 50%. Bonds were being eaten alive by inflation. Real estate was illiquid and cyclical. Management buyouts offered something different. The returns were not correlated with public markets. The investments were in real businesses with tangible assets and cash flows. The leverage magnified returns in a low valuation environment. If you bought businesses cheap and improved them, you could generate returns of 30 to 40% annually even in a tough economy. Historical track record supported this. The buyouts Kohlberg's team had done over the past 5 years had generated average returns exceeding 35% annually. The fundraising process took months, but gradually commitments came in. Some investors believed in the strategy. Others believed in the team. Jerry Kohlberg had a 20-year track record and impeccable reputation. Henry and George were young but impressively capable and had already proven themselves on numerous transactions. By late 1975, they had raised $35 million for their first fund. It was modest by later standards, but it was real capital that would allow them to pursue larger and more ambitious transactions. In 1976, they closed their first deal from the new fund. It was a manufacturing company being divested by a larger corporation. The business generated $5 million in annual cash flow, and they bought it for $30 million, using $5 million of equity from their fund and $25 million of bank debt. Over the next 3 years, they worked closely with management to improve operations. They invested in new equipment, streamlined production, expanded into new markets, and improved customer service. By 1979, the business was generating $8 million in cash flow, and they sold it for $65 million. After paying off debt, the equity investors received $45 million on their $5 million investment, a 9-fold return in 3 years. This success attracted attention. Investors in the fund were thrilled. Word spread in the investment community about the returns Kohlberg's team was generating. Other wealthy families wanted to invest. Pension funds started calling. Insurance companies expressed interest. Henry and George realized they were onto something bigger than they had imagined. The model worked, the demand was there, and the opportunity was vast. America was full of corporate divisions and private companies that could be bought, improved, and sold at significant profits. But there was a problem. Bear Stearns was not fully supportive. The firm's management viewed the buyout fund as a distraction from core businesses. They were concerned about conflicts of interest between the firm's investment banking clients and the buyout fund's investment activities. They worried about the risk to Bear Stearns' reputation if a highly leveraged deal went bad. There were compensation issues as well. The buyout team was generating substantial returns but sharing those profits with Bear Stearns under the existing arrangement. Henry and George believed they deserved a larger share of the economics they were creating. Throughout 1975 and 1976, tensions grew between Kohlberg's team and Bear Stearns' management. Kohlberg was loyal to Bear Stearns where he had worked for 20 years, but he recognized that the buyout business needed independence to reach its full potential. Henry and George were less patient. They were in their early 30s, ambitious, and frustrated by constraints. They began talking about leaving Bear Stearns to start their own firm. Kohlberg was torn but ultimately concluded they were right. The opportunity was too large and the constraints too limiting to stay. In 1976, after months of negotiation, Jerry Kohlberg, Henry Kravis, and George Roberts left Bear Stearns to form their own firm. They called it Kohlberg Kravis Roberts, taking the initials to create KKR. The name put Kohlberg first, acknowledging his seniority and experience. Kravis came before Roberts alphabetically, though the cousins viewed themselves as equals. The firm was structured as a partnership. All three were founding partners with equal profit sharing, though Kohlberg had slightly more authority as the senior partner. They set up offices in New York City, in a modest space that reflected their philosophy. This wasn't going to be a flashy operation. They hired a small staff, a few analysts and an assistant. The overhead was kept low. Every dollar mattered because they were investing their own money alongside their limited partners. If they succeeded, they would become wealthy. If they failed, they would lose everything. This alignment of interests between the general partners and limited partners became a cornerstone of KKR's culture. The founding of KKR in 1976 was a pivotal moment in American business history, though few recognized it at the time. Here were three men, one in his early 50s and two in their early 30s, starting a firm to buy entire companies using borrowed money. The concept was not entirely new, but what they were proposing to do at scale was revolutionary. They planned to buy not small divisions but major corporations. They would use massive amounts of leverage. They would impose operational discipline on management. And they would sell the businesses within 5 to 7 years, generating huge returns for their investors. The skeptics were numerous. Wall Street viewed them as renegades operating outside traditional boundaries. Corporate executives saw them as threats, raiders who would load companies with debt and strip assets. Labor unions viewed them with deep suspicion, fearing job cuts and broken promises. Journalists were skeptical about whether businesses could survive the debt loads KKR would impose. Even some investors worried whether the model was sustainable or just a product of the unique conditions of the mid-1970s. But Kohlberg, Kravis, and Roberts believed they had discovered something fundamental about American capitalism. Large corporations had become inefficient and complacent. Conglomerate structures destroyed value by forcing disparate businesses under one management team that couldn't effectively oversee them. Public company executives were not true owners and therefore didn't always act like owners. Incentives were misaligned. Management teams received salaries and bonuses whether the company performed well or poorly. Shareholders were dispersed and passive. Boards of directors were often friends of management, providing little oversight. KKR's model fixed these problems. By taking companies private, they eliminated the short-term pressures of public markets. Management could focus on long-term value creation. By loading the company with debt, they imposed discipline. Every dollar of free cash flow had to go toward paying down debt, not funding management pet projects. By giving management significant equity stakes, they aligned incentives. If the company succeeded, management would become wealthy. If it failed, they would lose their investment. This focused the mind wonderfully. The first few years of KKR were challenging. They had to prove the model worked at larger scale. Their initial fund was small, limiting the size of deals they could do. They had to build relationships with banks willing to lend hundreds of millions for buyout transactions. They had to convince corporate boards to sell them divisions or entire companies. They had to recruit management teams willing to take the risk of a leveraged buyout. And they had to deliver returns to their limited partners to raise the next fund. Henry and George divided responsibilities naturally based on their strengths. Henry focused on the East Coast from the New York office. George opened a West Coast office in San Francisco, giving KKR a bicoastal presence. This geographic split proved brilliant. They could cover more ground, source more deals, and build relationships in different business communities. Henry had a slightly more aggressive style, pushing hard in negotiations and driving deals to completion. George was more methodical and analytical, ensuring the financial structures were sound and the legal terms protected their interests. Jerry Kohlberg provided strategic oversight and wisdom gained from decades of experience. He was the firm's conscience, always asking whether a deal made sense, whether they were being fair to all parties, and whether their reputation would be enhanced or damaged. Kohlberg believed that character and reputation were everything. You could make a fortune, but if you lost your reputation, you had nothing. This philosophy permeated KKR's early culture. In 1977, KKR completed its first major transaction as an independent firm. The target was AJ Industries, a small conglomerate with diverse manufacturing operations. The company had a market value of around $25 million and was struggling under weak management and an unfocused strategy. KKR saw potential in the underlying businesses if they could be properly managed and the corporate overhead eliminated. They bought the entire company for $26 million using $7 million of equity and $19 million of debt. Henry led the transaction, working closely with a new management team they recruited to turn the company around. The strategy was straightforward but required disciplined execution. They immediately sold 2 non-core divisions, using the proceeds to pay down debt. They consolidated manufacturing facilities, reducing overhead. They renegotiated supplier contracts and focused the remaining businesses on their most profitable products and customers. Within 18 months, the company's cash flow had doubled. Within 3 years, they sold the company for $45 million. After paying off remaining debt, KKR and its investors received $30 million on their $7 million investment, more than a 4-fold return. This success validated their model, but KKR knew they needed to do larger deals to generate meaningful returns on bigger funds. The challenge was that larger deals required more equity and much more debt. Banks were willing to lend $50 or $60 million for a buyout, but getting them comfortable with $200 or $300 million was much harder. Henry spent countless hours with bank lending committees, explaining the economics, showing them the track record, and building relationships with senior bankers who could approve larger commitments. George worked on refining the financial structures. He realized that different types of lenders wanted different risk-return profiles. Senior banks wanted security and lower returns. Subordinated lenders would accept more risk for higher interest rates. Equity investors wanted the highest returns and were willing to take the most risk. By creating a capital structure with multiple layers, they could finance larger deals. A typical deal might have 40% senior bank debt, 20% subordinated debt, and 40% equity. This allowed them to buy much larger companies while still maintaining significant equity cushions. In 1979, KKR did a deal that announced their arrival as major players. They bought Houdaille Industries, a diversified industrial company, for $355 million. This was more than 10 times larger than any deal they had done before. Houdaille was a real company with thousands of employees and operations across multiple industries. The transaction required assembling a syndicate of banks to provide over $200 million in debt financing. It required convincing Houdaille's board that KKR could close such a large deal. It required recruiting a new CEO who could manage the company through a complex restructuring. Henry led the charge with characteristic intensity. He met with every major lender, walking them through the business plan, the cash flow projections, and the downside scenarios. He spent weeks with Houdaille's board, building trust and addressing concerns. He recruited a talented CEO from the industrial sector who understood the businesses and had credibility with banks and rating agencies. When the deal closed, it made headlines. KKR had bought a major American company using leverage in a transaction that demonstrated the private equity model could work at significant scale. The Houdaille deal was transformative for KKR in several ways. First, it proved they could execute large, complex transactions. Second, it generated substantial returns, with KKR eventually selling the company in pieces for over $700 million, nearly doubling the purchase price and generating a 4-fold return on equity. Third, it established relationships with major banks that would fund future deals. Fourth, it created a template for large leverage buyouts that would be replicated hundreds of times over the next decade. But the deal also revealed challenges. Managing a large, complex company through a leveraged buyout was difficult. The debt burden left little room for error. When Houdaille's automotive business faced a cyclical downturn in the early 1980s, debt payments became strained. KKR had to work closely with management to cut costs, sell non-core assets, and negotiate with lenders. It was stressful, but they navigated through it. The experience taught them valuable lessons about the importance of recession-resistant cash flows and the need for financial flexibility even in highly leveraged structures. By 1980, KKR had established itself as the leading firm in the emerging leveraged buyout industry. They had a track record of successful deals, relationships with major banks and investors, and a reputation for operational excellence. Other firms were entering the market, seeing the attractive returns KKR was generating. Firms like Forsman Little, Thomas H. Lee Partners, and Clayton Dubilier were starting to do significant buyouts. Competition was increasing, which pushed up purchase prices and made deals harder to find. Henry recognized that KKR needed advantages to stay ahead of competitors. One advantage was their reputation with management teams. KKR didn't just provide capital. They worked closely with management, providing strategic advice, helping recruit talent, and supporting them through challenges. Management teams who had worked with KKR became advocates, recommending them to other executives considering buyouts. This network effect gave KKR access to deals before they became broadly marketed. Another advantage was their relationship-driven approach to investing. While competitors often approached buyouts as financial transactions, KKR approached them as long-term partnerships. Henry would personally meet with management teams monthly or quarterly, staying involved without micromanaging. He would help with strategic decisions, leverage his network to help them recruit executives or find acquisition targets, and provide counsel during difficult times. This hands-on partnership model differentiated KKR from financial buyers who were more passive. George developed another advantage on the West Coast. He built deep relationships in the technology and healthcare sectors, which were growing rapidly in California. While most buyout firms focused on traditional manufacturing and distribution businesses, George saw potential in technology-enabled companies and healthcare services. These businesses had higher growth rates and stronger competitive positions. They were less cyclical than traditional industrial companies. George began doing deals in these sectors before competitors recognized the opportunity. The early 1980s brought both opportunity and challenge. The economy entered a severe recession in 1981 and 1982. Interest rates spiked to nearly 20% as the Federal Reserve fought inflation. Unemployment reached levels not seen since the Depression. Corporate profits plummeted. The stock market struggled. Many of KKR's portfolio companies faced difficulties as their revenues declined and debt service became more expensive. This was the first real test of whether the leveraged buyout model could survive a serious downturn. Henry and George spent much of 1981 and 1982 working with portfolio company management teams to navigate the recession. They helped renegotiate bank covenants when companies missed financial targets. They provided additional capital when companies needed liquidity. They made difficult decisions about selling assets or closing facilities to preserve cash. In a few cases, they had to replace management teams that couldn't handle the crisis. It was brutal, grinding work with their reputations and track records on the line. Most of KKR's companies survived the recession, though some barely. The experience reinforced several lessons. First, balance sheet strength mattered enormously. Companies with too much debt relative to cash flow were vulnerable even if their businesses were fundamentally sound. Second, management quality was critical. Great managers found ways to cut costs, preserve margins, and navigate through the downturn. Weak managers panicked or made poor decisions that made things worse. Third, sector selection mattered. Recession-resistant businesses like food, healthcare, and essential services held up better than cyclical industries like automotive and construction. These lessons shaped KKR's approach going forward. They became more conservative about leverage, leaving more cushion between cash flow and debt service requirements. They became even more rigorous about assessing management teams, looking for executives who had navigated prior downturns successfully. They shifted their sector focus toward businesses with more stable demand patterns. These changes would prove crucial when they pursued larger and more visible transactions in the mid-1980s. The recession ended in late 1982, and the economy began a strong recovery that would last through the rest of the decade. Interest rates declined, corporate profits rebounded, and the stock market began a historic bull run. This created ideal conditions for leveraged buyouts. Companies were growing, generating strong cash flows that could support debt. Banks were eager to lend after pulling back during the recession. Sellers were willing to divest divisions and subsidiaries at reasonable prices. Competition among buyout firms was manageable, keeping valuations from getting too expensive. KKR went on an aggressive deal spree from 1983 to 1986. They completed more than 20 transactions during this period, ranging from $50 million to over $500 million. Each deal refined their playbook and expanded their capabilities. They developed industry expertise in sectors like retail, media, manufacturing, and food production. They built relationships with hundreds of executives who could step into portfolio company roles. They established preferred lender relationships with dozens of banks. They became a well-oiled deal machine. One particularly important transaction during this period was the 1984 buyout of Wameco Enterprises, a Florida-based company with television stations, cable systems, and bottling operations. The deal was significant not for its size but for its structure. KKR introduced innovative securities to the capital structure, including payment-in-kind bonds that allowed the company to pay interest with additional bonds rather than cash for the first few years. This reduced cash flow pressure during the critical early years after the buyout. The structure worked brilliantly, and KKR used variations of it in many subsequent deals. Henry was becoming a public figure during this period, though he didn't particularly seek publicity. Business journalists started writing profiles of the mysterious men who were buying major companies with borrowed money. Henry gave occasional interviews, always emphasizing that KKR was not a raider but a builder of businesses. They didn't break up companies and sell the pieces. They improved operations and grew revenues. They created value for all stakeholders, including employees, customers, and communities, not just investors. This messaging was important as KKR faced increasing scrutiny. By 1986, KKR had raised its fourth fund, with over $2 billion in commitments. This was an enormous amount of capital, more than 10 times their first fund just 10 years earlier. The limited partners included major pension funds, university endowments, insurance companies, and wealthy families from around the world. These investors had earned spectacular returns from earlier KKR funds and were eager to commit more capital. KKR's track record was extraordinary, with annualized returns exceeding 40% across multiple funds and economic cycles. With $2 billion to invest, KKR could pursue much larger transactions. Companies worth billions of dollars were now potential targets. This opened up opportunities that had been unimaginable when they started. Fortune 500 companies could be taken private. Entire industries could be reshaped. The scale of what was possible had fundamentally changed. Henry and George began thinking bigger, looking at companies that would have seemed impossibly large just a few years earlier. The firm had also grown significantly. KKR now employed dozens of investment professionals, with offices in New York, San Francisco, and London. They had built a global platform capable of executing deals across industries and geographies. They had developed specialized expertise in due diligence, financing, and operations. They had recruiting relationships to find CEOs and senior executives for portfolio companies. They had become an institution, no longer just three guys with an innovative idea but a major force in American capitalism. But success brought challenges. Other buyout firms had raised large funds and were competing aggressively for deals. Competition was driving up purchase prices, reducing returns. Banks were lending more aggressively, allowing buyers to use higher leverage. The market was getting frothy. Henry worried they were in a bubble, that valuations had gotten ahead of fundamentals. He remembered his father's warnings about not overpaying no matter how good a business looked. In heated markets, discipline was even more important than in normal times. There were also tensions within KKR. Jerry Kohlberg, now in his early 60s, was becoming uncomfortable with the direction of the firm. He worried that Henry and George were doing deals too aggressively, using too much leverage, and taking excessive risks. He felt the firm was losing its conservative roots and becoming more like the financial cowboys they had always disdained. The disagreements were mostly private, but occasionally they boiled over in partners' meetings. The philosophical differences between Kohlberg and the cousins came to a head in 1986 and 1987. Kohlberg believed in smaller deals where KKR could work closely with management and add value through hands-on involvement. He thought that billion-dollar deals were too large to manage effectively and too dependent on financial engineering rather than operational improvement. He was concerned about the firm's reputation if a large deal went badly. Most fundamentally, he felt that Henry and George had become too focused on size and prestige rather than returns and relationships. Henry and George saw things differently. They believed the opportunity was in large-cap buyouts where KKR could apply their model at scale. Small deals didn't move the needle anymore given the size of their fund. They needed to deploy billions of dollars, which required doing big transactions. They also believed they had the capabilities to manage large, complex companies. Their track record proved they could execute. The market was giving them opportunities to buy iconic American companies at reasonable valuations. Why would they turn that down out of excessive caution? The tension was also personal. Kohlberg was the senior founding partner and expected deference from the younger partners. But Henry and George were now in their early 40s, seasoned investors with their own strong views. They had done many successful deals and felt they had earned the right to drive strategy. They respected Kohlberg immensely as a mentor and the father of the buyout industry. But they no longer felt they needed his permission to pursue opportunities they believed were attractive. The break came in 1987. After months of increasingly difficult conversations, Kohlberg decided to leave KKR. The departure was handled professionally and privately. There was no public acrimony or litigation. Kohlberg retained his economic interests in prior funds but would not participate in future investments. Henry and George would run the firm going forward. They dropped the Kohlberg name from marketing materials but kept the KKR brand and initials, which were now well established in the market. Kohlberg's departure was emotional for everyone involved. He had created the leveraged buyout model and mentored both Henry and George. The three men had built KKR together over more than a decade. They had succeeded beyond anyone's imagination. But the split was probably inevitable. Kohlberg was from a different generation with different values about appropriate risk and scale. Henry and George were younger, more aggressive, and more comfortable with the mega deals that were becoming possible. Sometimes even successful partnerships reach natural endpoints. Now fully in control, Henry and George pushed KKR to new heights. In 1987, they completed the buyout of Owens, Illinois, a major glass and plastics manufacturer, for $3.7 billion. This was one of the largest leveraged buyouts ever completed at that time. The transaction required assembling a massive financing package with layers of bank debt, subordinated bonds, and preferred stock. It required convincing Owens, Illinois board and shareholders that the offer price was fair. It required recruiting a CEO who could manage the company through a difficult transition. Henry personally led the Owens, Illinois negotiations. He met with the company's board multiple times, building relationships and trust. He worked with the CEO to develop a post-buyout operating plan. He coordinated with banks and bond investors to secure financing commitments. When shareholder activists complained the price was too low, he increased the offer. When banks worried about the company's cyclical earnings, he added financial covenants to protect them. The deal nearly fell apart several times, but Henry's determination and deal-making skills kept it alive. The Owens, Illinois buyout was important for several reasons beyond its size. First, it demonstrated that truly massive companies could be taken private through leveraged buyouts. There was essentially no limit to what KKR could attempt. Second, it showed that even in competitive situations with multiple bidders, KKR could win through superior financing capabilities and relationships. Third, it proved that industrial companies with complex operations could be successfully managed in highly leveraged structures. The playbook was established and could be scaled indefinitely. But 1987 also brought crisis. In October, the stock market crashed, falling more than 20% in a single day. This was Black Monday, the largest one-day percentage decline in stock market history. Panic swept through financial markets. Banks stopped lending. Bond markets froze. The economy seemed poised to fall into recession or worse. For leveraged buyout firms like KKR, which depended on borrowed money and buoyant markets, this was a potential catastrophe. Henry's response to the crash was characteristically aggressive. While competitors pulled back and stopped doing deals, he saw opportunity. Valuations had reset lower. Sellers were more motivated because their stock prices had collapsed. Competition had disappeared as other firms waited to see what would happen. This was exactly when KKR should be most active, not least active. He told his team they would pursue deals even more aggressively in the aftermath of the crash. This contrarian approach paid off. Over the next 18 months, KKR completed several major transactions at attractive valuations. Companies that would have commanded premium prices before the crash were now available at reasonable multiples. Banks, after an initial pause, resumed lending because they needed to deploy capital, and KKR had the best track record in the industry. Investors in KKR's funds appreciated the discipline of buying when others were fearful. This was exactly how to generate superior long-term returns. During this period, Henry also refined KKR's approach to adding value in portfolio companies. It wasn't enough to buy companies cheap and hope they improved. KKR developed a systematic methodology for operational improvement. They created benchmarking tools to compare portfolio company performance against best-in-class competitors. They brought in consultants to identify efficiency opportunities. They developed management training programs to upgrade talent. They created compensation systems that aligned executive incentives with equity value creation. Henry personally spent time with each portfolio company CEO, usually meeting quarterly to review performance and strategy. These weren't perfunctory meetings. Henry would prepare extensively, reviewing detailed financial reports and operational metrics. He would ask tough questions about why costs were higher than competitors, why certain initiatives were behind schedule, or why key customers were being lost. He pushed management teams hard but also supported them with resources and advice. The combination of pressure and support brought out the best in most executives. By 1988, KKR was at the peak of its power and influence. The firm had over $4 billion in equity capital to deploy. They had completed dozens of successful buyouts across multiple industries. Their returns remained exceptional, well above 30% annually. They had relationships with every major bank and institutional investor. They could call CEOs of Fortune 500 companies and get meetings immediately. They had become the most powerful buyout firm in the world and one of the most influential forces in American capitalism. But with power came visibility and criticism. Journalists were writing critical articles about leveraged buyouts and corporate raiders. Labor unions were organizing campaigns against buyout firms, accusing them of destroying jobs and communities to enrich wealthy investors. Politicians were holding hearings about the social costs of financial engineering. A best-selling book called Barbarians at the Gate would soon be published, chronicling a massive buyout battle and portraying the industry in unflattering terms. KKR was not insulated from this criticism despite their efforts to position themselves as responsible operators. Henry was sensitive to the criticism, perhaps more than George. He genuinely believed KKR created value and helped companies. He thought their involvement made businesses more efficient and competitive, which benefited everyone in the long run. He was frustrated that journalists and politicians didn't understand the nuances of what they did. But he also recognized that perception mattered. If KKR was seen as greedy raiders, it would hurt their ability to do deals, recruit management teams, and raise capital from institutional investors who cared about reputation. In response, KKR hired a public relations firm to help manage their image. They began giving more interviews and speeches explaining their philosophy. They published reports showing that employment actually increased at most of their portfolio companies after buyouts. They highlighted investments they made in facilities, equipment, and training. They emphasized long-term value creation over short-term financial engineering. Henry personally became more accessible to journalists, hoping to change the narrative about who KKR was and what they stood for. Then came the deal that would define KKR and Henry Kravis forever. In October 1988, the management team at RJR Nabisco, led by CEO Ross Johnson, proposed taking the company private in a leveraged buyout. RJR Nabisco was a giant, one of the 20 largest companies in America, with iconic brands including Winston cigarettes, Oreo cookies, and Ritz crackers. The company had revenues exceeding $15 billion and employed over 100,000 people. Taking it private would require the largest leveraged buyout in history, potentially costing $20 billion or more. When Henry heard that RJR Nabisco was in play, he immediately recognized this was the opportunity of a lifetime. This wasn't just a large deal. This was a transformative transaction that would establish KKR as the dominant force in American finance. If they could successfully take private and turn around one of America's largest companies, there would be nothing they couldn't do. Every board, every CEO, every banker would take their calls. They would be kings of the financial universe. But the RJR deal would also be the ultimate test of everything Henry had learned over 20 years. The company was huge and complex, with operations around the world. The management team was proposing their own buyout, creating a conflict of interest with shareholders. Other buyout firms would certainly bid, creating a competitive auction. The deal would require unprecedented amounts of debt, pushing leverage to levels never before attempted. The transaction would be conducted in the full glare of media attention and public scrutiny. Everything could go wrong. Henry assembled his team and they began working around the clock to develop a bid for RJR Nabisco. They analyzed the company's businesses in excruciating detail, examining the cash flows, competitive positions, and growth prospects of each division. They met with potential management team members who could run the company if the existing team was replaced. They began lining up financing commitments from banks and bond investors. They retained lawyers to navigate the complex bidding process. They prepared for the battle of their lives. The competition for RJR Nabisco quickly became intense. Ross Johnson and his management team partnered with Shearson Lehman Hutton to bid for the company. Another major buyout firm, Forsman Little, also entered the bidding. Each group submitted proposals to the RJR Nabisco board, which had formed a special committee to evaluate offers and protect shareholder interests. The process became a media circus, with journalists reporting on every twist and turn. Business publications ran daily updates on the bidding. The battle was front-page news. Henry approached the RJR situation with characteristic intensity and strategic thinking. He recognized that this wasn't just about offering the highest price. The board cared about certainty of closing, management plans for the company, and the bidder's reputation and track record. KKR had advantages in all these areas. They had never failed to close a deal they had committed to. They had a detailed operating plan for improving RJR's performance. They had the best track record in the industry. Henry made sure the board understood these advantages in every meeting. The bidding process stretched over several weeks in late 1988. Each group submitted initial bids, then revised bids as the special committee pushed for higher prices. KKR's first bid was $90 per share, valuing the company at approximately $20 billion. The management group bid $92 per share. Forsman Little bid $89. The special committee rejected all bids as inadequate and asked for final offers. The pressure was immense. Billions of dollars were at stake. Reputations would be made or destroyed. Henry barely slept, working day and night to refine KKR's proposal. KKR faced a strategic dilemma. They could offer a very high price to ensure they won, but overpaying would destroy returns and potentially saddle the company with unmanageable debt. They could be disciplined about valuation and risk losing the deal to a more aggressive bidder. Henry agonized over this trade-off. His competitive instinct screamed to do whatever it took to win. His investment discipline warned against the winner's curse, the tendency for auction winners to overpay. He needed to find a balance. Henry made a crucial decision. KKR would not get into a bidding war based purely on price. Instead, they would differentiate their bid on structure and certainty. They offered a mix of cash and securities rather than all cash, which reduced the financing risk. They provided detailed financing commitments rather than vague assurances. They committed to keep headquarters in Atlanta and retain most of the management team, addressing concerns about jobs and community impact. They emphasized their track record of successful large buyouts. The bid was compelling in ways beyond just the dollar amount. On November 30, 1988, the RJR Nabisco board met to make a final decision. 3 bids were on the table. The management group had bid $100 per share. Forceman Little had withdrawn after concluding the price had gone too high. KKR had bid $109 per share, a total package worth approximately $25 billion. This was more than double KKR's previous largest transaction. It would be the largest leveraged buyout in history by a massive margin. The board deliberated for hours, examining every aspect of each proposal. The board selected KKR's bid. The combination of price, financing certainty, and KKR's track record carried the day. When Henry received the call informing him that KKR had won, he felt a mix of elation and anxiety. They had won the greatest prize in the history of leveraged buyouts. But now they had to close the transaction and make it work. If they failed, if RJR Nabisco collapsed under its debt burden, the entire leveraged buyout industry might be destroyed and KKR's reputation ruined forever. The stakes could not have been higher. The next several months were consumed with closing the transaction. KKR had to finalize commitments for over $20 billion in debt financing from dozens of banks and bond investors. They had to get regulatory approvals from antitrust authorities. They had to integrate the management team and develop detailed operating plans. They had to navigate media scrutiny and public criticism about the deal. Henry was in constant motion, meeting with bankers, lawyers, executives, and investors, holding the deal together through sheer force of will. The RJR Nabisco transaction closed in April 1989. KKR and its investors put up approximately $3 billion in equity. The rest was borrowed from banks, insurance companies, and bond investors. The capital structure was incredibly complex with multiple layers of debt, from senior secured bank loans to junior subordinated bonds. The interest expense alone would consume most of the company's cash flow, leaving little margin for error. If revenues declined or interest rates rose significantly, the company could face a financial crisis. Henry installed a new management team led by Lou Gerstner, an executive recruited from American Express who was known as a brilliant strategist and operational leader. Gerstner's mandate was clear: improve operations, increase cash flow, pay down debt, and position the company for eventual success. The playbook was the same as every other KKR deal, just at vastly larger scale. Divest non-core assets. Cut overhead. Focus on the most profitable brands and products. Improve marketing and innovation. Execute with discipline and speed. But the RJR Nabisco deal immediately faced challenges. The tobacco business was under increasing legal and regulatory pressure. Smoking rates were declining. Lawsuits were mounting. This business, which generated much of the company's cash flow, was structurally challenged. The food businesses faced intense competition from other major companies with lower cost structures. Economic conditions were weakening as the economy slowed in 1989 and 1990. The debt burden left no room for mistakes or bad luck. The deal also unleashed a firestorm of criticism. A book called Barbarians at the Gate, written by Wall Street Journal reporters Brian Burrow and John Hellier, chronicled the battle for RJR Nabisco in vivid detail. The book portrayed the whole episode as an example of Wall Street greed and excess. Ross Johnson was depicted as living lavishly on shareholder money. The bidding process was shown as chaotic and driven by egos. The leveraged buyout industry was characterized as value-destroying financial engineering that benefited investors at the expense of employees and communities. Henry and KKR were actually portrayed relatively favorably in the book compared to some other participants. The authors acknowledged KKR's professionalism and track record. But the overall narrative was damaging to the industry. The book became a massive bestseller and was later adapted into a television movie. It entered popular culture as a symbol of 1980s excess. The phrase "Barbarians at the gate" became shorthand for corporate raiders and hostile takeovers. Henry hated that their greatest triumph had become associated with greed and financial manipulation. More seriously, the political and regulatory environment was turning hostile to leveraged buyouts. Congress held hearings on the social costs of LBOs and considered legislation to restrict the use of debt in acquisitions. The Securities and Exchange Commission proposed rules to make hostile takeovers more difficult. State legislatures passed anti-takeover laws to protect local companies. Banks faced pressure to reduce lending for leveraged buyouts. The junk bond market, which had financed many deals, was collapsing amid scandals and defaults. Then the economy slipped into recession in 1990 and 1991. Corporate profits declined. Many companies that had been taken private in leveraged buyouts faced financial stress as revenues fell while debt service remained fixed. Some companies defaulted on their bonds or violated loan covenants. A few high-profile bankruptcies occurred, including some deals done by KKR's competitors. The media ran stories about failed LBOs and workers losing jobs. Politicians and activists pointed to these failures as proof that leveraged buyouts were fundamentally flawed. KKR's portfolio companies, including RJR Nabisco, struggled during this period. Several companies had to renegotiate their debt agreements with lenders. Management teams cut costs aggressively to preserve cash. Some assets were sold to pay down debt faster than originally planned. Henry spent enormous amounts of time working with portfolio company CEOs, providing advice and moral support. He also met repeatedly with lenders to maintain their confidence and prevent them from forcing companies into bankruptcy. RJR Nabisco was particularly challenging. The tobacco business faced accelerating headwinds. The food businesses were underperforming. The debt burden was crushing. In 1990, KKR made the difficult decision to inject additional equity capital into RJR to strengthen the balance sheet. This was painful because it reduced the returns on their original investment. But it was necessary to prevent a default that could trigger bankruptcy. Henry personally led the negotiations to restructure some of RJR's debt at more favorable terms. Despite the difficulties, Henry maintained his conviction that the deal would ultimately succeed. He believed in the underlying quality of RJR's brands and businesses. Oreos and Ritz crackers weren't going away. Winston and Salem cigarettes still generated enormous cash flows despite declining volumes. The problems were temporary, caused by recession and excessive leverage. Over time, as debt was paid down and operations improved, value would be created. They just had to survive the near-term crisis. The early 1990s were the most difficult period of Henry's career. The RJR deal, which was supposed to be his crowning achievement, had become an albatross. Critics pointed to it as evidence that KKR had gotten too aggressive and paid too much. Some investors in KKR's funds questioned whether the returns would justify the risk. The media scrutiny was intense and often hostile. The political environment was toxic. Henry wondered if he had made a terrible mistake in pursuing RJR so aggressively. But Henry's character, forged in his Tulsa childhood and refined over decades of deal-making, sustained him through this crisis. He had his father's integrity and determination. He refused to give up. He worked harder than ever, spending time with each portfolio company, solving problems one by one. He maintained relationships with banks and investors, keeping their confidence even when results were disappointing. He believed that if he executed well and survived long enough, the economic cycle would turn and the underlying value would be realized. Gradually, conditions improved. The recession ended in 1991. The economy began recovering. Corporate profits rebounded. KKR's portfolio companies returned to growth. Debt was being paid down from operating cash flows. Several companies were sold at significant profits, demonstrating that the model still worked. Lou Gerstner and his team made progress improving RJR's operations. The tobacco litigation was managed. The food brands were revitalized. The company's cash generation improved year by year. By 1993 and 1994, it was becoming clear that the RJR deal would ultimately be successful. The company had survived the crisis and was thriving. Debt had been reduced dramatically. The businesses were stronger than when KKR bought them. Market conditions were improving. Henry began planning for an eventual exit, either through selling the company or taking it public again. The value had been created. Now they needed to realize it for their investors. In 1991, KKR took RJR Nabisco public again through an initial public offering. They sold a portion of their shares but retained a large stake. Over the next several years, they gradually sold their remaining shares as the stock price appreciated. By the time they fully exited in 1995, they had generated substantial returns for their investors. The exact returns were lower than typical KKR deals because of the high price paid and challenges faced. But given the size and complexity of the transaction, generating positive returns at all was an achievement. The RJR Nabisco saga taught Henry crucial lessons that shaped the rest of his career. First, size matters, but so does price discipline. Winning a competitive auction often means overpaying. Better to lose deals than pay too much. Second, leverage is powerful but dangerous. The more debt you use, the less margin for error. Conservative leverage structures might reduce returns, but they also reduce risk of catastrophic loss. Third, reputation and relationships matter more than short-term results. KKR's reputation for integrity and operational excellence sustained them through difficult times. Fourth, cyclicality is inevitable. Markets and economies go up and down. Deals done at cycle peaks face headwinds. Deals done during downturns have tailwinds. Timing matters enormously. Fifth, media perception shapes reality. Being portrayed as greedy raiders rather than value creators made everything harder. Managing public relations was as important as managing portfolio companies. Sixth, industries change. Tobacco was structurally declining no matter how well you managed the business. Secular trends matter more than operational excellence. Most importantly, Henry learned that success requires endurance through adversity. The worst moments test your character and conviction. Do you panic and sell at the bottom, or do you stay committed to your analysis and work through problems? Henry chose endurance, and it was the right choice. But it required extraordinary mental toughness, confidence, and resilience. Not everyone has that. It can't really be taught. You either have it or you don't. By the mid-1990s, KKR had emerged from the difficult period stronger than ever. They had survived the recession and industry backlash. Their portfolio had recovered. Their track record remained strong over the long term. They raised new funds from investors who appreciated their discipline during tough times. The leveraged buyout market was recovering as the economy grew and credit became available again. But the industry had changed. The mega deals and aggressive leverage of the late 1980s were gone. The new era would be characterized by more moderate valuations and capital structures. Henry adapted KKR's strategy to the new environment. They focused on middle market deals where competition was less intense. They used less leverage, typically funding deals with 40 to 50% equity rather than 20 to 30%. They emphasized operational value creation over financial engineering. They built an in-house operations consulting team to work with portfolio companies on efficiency improvements. They expanded geographically, opening offices in Europe and Asia. They diversified into new strategies beyond just leveraged buyouts, including growth equity, real estate, and infrastructure. Henry also evolved personally. He was now in his 50s, no longer the hungry young dealmaker but an elder statesman of the industry. He had seen boom and bust cycles, successes and failures, praise and criticism. He had become wealthier than he ever imagined, with a personal fortune estimated in the hundreds of millions or billions of dollars. He served on prestigious corporate and non-profit boards. He was a major philanthropist, giving tens of millions to hospitals, universities, and cultural institutions. He had arrived at the pinnacle of American capitalism. But Henry never lost the drive that had propelled him from Tulsa to Wall Street. He still worked long hours, still pursued deals with intensity, still demanded excellence from himself and his team. Making money had never been the primary motivation. It was about winning, about building something significant, about proving himself in the most competitive arena in the world. His father had taught him that your work defines you. Henry's work was buying, improving, and selling companies. He was the best in the world at it. That identity mattered more than wealth or status. Henry Kravis is now in his 80s, still active at KKR as a senior partner and chairman of the board. The firm he co-founded in 1976 with less than $50 million now manages over $500 billion across multiple strategies and geographies. KKR is a global alternative asset management powerhouse with thousands of employees and investments in hundreds of companies. The firm has generated hundreds of billions in value for investors over nearly 5 decades. It has shaped how corporate America is managed, financed, and governed. The leveraged buyout model Henry helped pioneer has been applied to countless companies, creating value but also controversy. Looking back on Henry's career, several themes emerge that explain his extraordinary success. First is the foundation laid in his childhood. Growing up in Tulsa watching his father do oil and gas investments, Henry absorbed the fundamental principles of value investing before he could articulate them. He learned that price and value are different, that assets can be improved through better management, that leverage magnifies returns, and that relationships matter as much as analysis. These lessons became instinctive, part of how he saw the world. Second is the quality of mentorship Henry received. Jerry Kohlberg took a young MBA student and taught him the management buyout model, gave him responsibility early, and showed him how to build a business with integrity. Kohlberg's influence on Henry was profound. The emphasis on partnerships with management, on operational improvement over financial engineering, on reputation and relationships, all came from Kohlberg. Even after they parted ways, those principles remained central to how Henry operated. Third is the partnership with George Roberts. Having a partner who was also family created unique advantages. They trusted each other completely, which allowed them to move quickly without endless debate. They had complementary skills, with Henry focused on relationships and deal execution while George handled financial structures and operations. They divided geography, with Henry on the East Coast and George on the West Coast, allowing them to cover more ground. The partnership was one of the great business collaborations, comparable to Buffett and Munger or the Google founders. Fourth is timing. Henry entered the leveraged buyout industry in the early 1970s just as it was being invented. He rode the wave as the industry grew from essentially zero to trillions of dollars. He was in the right place at the right time with the right skills. If he had been born 20 years earlier or later, the opportunity might not have existed. He had the wisdom to recognize the opportunity and the courage to seize it, but luck played a role too. All great success stories involve timing and fortune. Fifth is work ethic and intensity. Henry worked harder than almost anyone, routinely putting in 80 to 100-hour weeks for decades. He never took his foot off the gas, never coasted on past success. Every deal received his full attention and energy. This relentless drive set the tone for KKR's culture. Everyone worked incredibly hard because that's what Henry did. The intensity could be exhausting, but it was also inspiring. People wanted to be part of something where excellence was demanded and achieved. Sixth is relationship building. Henry invested enormous time cultivating relationships with management teams, bankers, investors, and other stakeholders. He remembered names, asked about families, followed up after meetings. People liked him and wanted to work with him. This gave KKR access to deals before they were broadly marketed. It allowed them to win competitive situations because management teams trusted them. It enabled them to raise capital from the best institutional investors. Business is ultimately about people, and Henry was exceptional with people. 7th is adaptability. Henry evolved as markets and industries changed. In the 1970s, he did small management buyouts. In the 1980s, he pursued mega deals. In the 1990s, he became more conservative after learning painful lessons. In the 2000s, he expanded KKR globally and into new strategies. He never got stuck doing what worked in the past. He constantly learned, adjusted, and improved. This intellectual flexibility allowed him to remain relevant across 5 decades as the financial world transformed around him. 8th is resilience. Henry faced enormous challenges. The Nabisco deal nearly destroyed his reputation. The early 1990s recession tested his portfolio. Media criticism was often brutal. Political opposition threatened the industry. Competitors tried to steal market share. Through it all, Henry persevered. He didn't panic, didn't give up, didn't compromise his principles. He believed in his model and his team. He worked through problems rather than running from them. This resilience, more than brilliance or luck, explains his longevity. The broader impact of Henry Kravis and KKR on American capitalism is significant and controversial. On the positive side, they demonstrated that many companies were poorly managed and could be dramatically improved through better incentives and operational focus. They showed that ownership matters, that when management has real equity stakes they perform differently. They proved that mature businesses could be revitalized rather than allowed to decline. They created substantial wealth for pension funds and endowments, helping fund retirements and education. KKR's involvement often led to better performance. Profit margins improved, returns on capital increased, and businesses became more competitive. Many companies that KKR bought, improved, and sold went on to thrive under new ownership. The discipline that leverage imposed, forcing management to focus on cash flow and efficiency, often made businesses stronger. The operational expertise KKR developed, the ability to benchmark performance and implement best practices, added real value beyond just financial structuring. Henry and KKR also helped democratize wealth creation in corporate America. Before leveraged buyouts, most wealth creation in companies benefited founding families or public shareholders. Management teams earned salaries and bonuses but rarely became wealthy. The LBO model gave management teams equity stakes that could become worth millions or tens of millions if the company performed well. This aligned incentives and created powerful motivation. Many middle managers became wealthy through successful buyouts, spreading prosperity beyond just the investor class. But there were also negative consequences. The high leverage used in many deals created financial fragility. When business conditions deteriorated, highly leveraged companies faced distress or bankruptcy. This led to job losses, facility closures, and community disruption. Workers who had devoted careers to companies suddenly found themselves laid off as new owners cut costs to service debt. Some communities were devastated when major employers were acquired, restructured, and ultimately closed or moved. The focus on short-term cash generation to pay debt sometimes led to underinvestment in research, equipment, and training. Companies optimized for near-term results at the expense of long-term competitiveness. Some businesses that thrived for decades before buyouts struggled afterwards, unable to invest adequately while managing heavy debt burdens. The criticism that LBOs extracted value rather than created it had validity in some cases, even if not universally true. The leveraged buyout wave of the 1980s also contributed to the financialization of the American economy. More talent and capital flowed into financial engineering rather than building new businesses or products. The smartest graduates increasingly chose investment banking and private equity over engineering, medicine, or scientific research. Society arguably suffered when so much brainpower focused on shuffling ownership of existing assets rather than creating new value. Henry and KKR didn't cause this trend alone, but they were part of it. The extreme wealth accumulated by successful private equity investors also contributed to rising inequality. Henry's personal fortune, estimated at several $billions, exemplifies this. He and his partners earned carried interest, the share of profits from successful investments, which was taxed at favorable capital gains rates. This allowed them to accumulate wealth at rates far exceeding traditional salaried professionals. Whether this level of wealth accumulation is justified by the value created or represents excessive extraction of economic rents remains debated. Henry has been a significant philanthropist, giving hundreds of millions to various causes. He funded medical research facilities, university buildings, arts institutions, and community programs. The Kravis name appears on buildings at Columbia Business School, the Metropolitan Museum of Art, and multiple hospitals. This philanthropy has funded important work that might not otherwise occur. But critics argue that allowing such extreme wealth accumulation in the first place, necessitating philanthropy, is less efficient than more equitable distribution through higher wages or taxes. The political influence of private equity has also been concerning. The industry lobbied aggressively to maintain favorable tax treatment of carried interest and to resist regulations limiting leveraged buyouts. Substantial campaign contributions flowed to politicians of both parties. This allowed the industry to shape policy in its favor, potentially at public expense. Henry personally was never as politically active as some peers, but KKR as an institution participated in these efforts to protect its interests. Despite these criticisms, Henry's achievements remain remarkable. He helped create an entirely new industry that has allocated trillions of dollars of capital across thousands of companies and millions of workers. He built an institution in KKR that will outlast him, continuing to operate according to principles he established. He demonstrated that a kid from Tulsa with no family wealth or connections could reach the pinnacle of American finance through intelligence, hard work, and integrity. His story, whatever its controversies, is undeniably impressive. Henry's investment philosophy, distilled over 5 decades, can be summarized in several core principles. First, buy good businesses at fair prices rather than fair businesses at great prices. Quality matters more than cheapness. A strong business with competitive advantages can overcome mistakes or bad luck. A weak business rarely thrives no matter how cheap. Second, management quality is paramount. The best business with terrible management will underperform. An average business with exceptional management can succeed. Spend enormous time assessing management character, capability, and motivation. Third, align incentives through equity ownership. When management has significant personal wealth at stake, behavior changes. They think like owners, not employees. They make hard decisions, cut waste, invest for long term. The power of properly aligned incentives cannot be overstated. Fourth, operational improvement drives lasting value. Financial engineering creates temporary gains. Real value comes from improving products, serving customers better, operating more efficiently. Focus on operations and the financial returns will follow. Fifth, protect downside through conservative leverage. The upside takes care of itself if you buy good businesses. The downside destroys you if you over-leverage. Use enough debt to generate attractive returns but leave cushion for adversity. The worst case is permanent loss of capital, which must be avoided. Sixth, build relationships before you need them. The time to develop trust with management teams, bankers, and investors is long before you need their help on a specific deal. Invest in relationships continuously. Seventh, think like a principal, not an agent. Your capital should be at risk alongside your investors. Never recommend something you wouldn't invest your own money in. This alignment forces discipline and integrity. Eighth, reputation is everything. It takes decades to build and moments to destroy. Never compromise integrity for a deal. Be known for honesty, fairness, and delivering on commitments. This reputation becomes your most valuable asset. Ninth, adapt to changing conditions. What worked yesterday may not work tomorrow. Markets evolve, industries transform, regulations change. Stay flexible and intellectually curious. 10th, endure through adversity. The worst times test your conviction and character. Markets go through cycles. Individual deals face unexpected challenges. The survivors are those who maintain discipline during fear and greed. who work through problems rather than panicking. This requires deep reservoirs of resilience. Finally, remember that business is ultimately about people. Behind every transaction are human beings with hopes, fears, and families. Treat everyone with respect. Consider all stakeholders, not just investors. Build things that make the world better, not just yourself richer. These principles sound simple, almost obvious when stated. But they're incredibly difficult to follow consistently across decades and market cycles. The temptation to overpay in a competitive auction is intense. The pressure to use more leverage to boost returns is constant. The urge to cut corners when times are tough is real. Henry's achievement was not discovering these principles, many were known before him, but actually living them through every deal, good times and bad, for 50 years. That consistency of execution is what separates the truly great from the merely good. Henry's legacy extends beyond just financial returns and portfolio companies. He helped legitimize private equity as an asset class for institutional investors. Before KKR, pension funds and endowments were skeptical of investing in leveraged buyouts. It seemed too risky, too opaque, too different from stocks and bonds. KKR's consistent returns over multiple cycles proved that private equity could generate superior returns with acceptable risk. This opened the floodgates to trillions of dollars flowing into the asset class. He also established standards for the industry. KKR's governance practices, operational improvement methodologies, and investor communication became models that others emulated. The quarterly meetings with portfolio company management, the detailed financial reporting to limited partners, the operational benchmarking tools, all of these became industry standard practices. Henry showed how to do private equity professionally and institutionally rather than as bespoke one-off transactions. Henry trained a generation of investment professionals who went on to lead other firms and companies. Dozens of former KKR employees became partners at other private equity firms or CEOs of major corporations. They took the lessons learned at KKR and applied them elsewhere, multiplying the impact. This alumni network became another of Henry's legacies, shaping how corporate America operates far beyond just KKR's direct portfolio. At a personal level, Henry's story illustrates timeless themes about success and achievement. He came from privilege, certainly, an upper-middle-class family in Tulsa gave him advantages many lack. But he wasn't born into the elite. He had to earn his place through performance. He attended good schools but not always the most prestigious ones. He worked at Bear Stearns, a scrappy second-tier firm, not Goldman Sachs. He built his success through merit, hard work, and relationship building rather than inherited position. The partnership with his cousin George shows the power of finding the right collaborators. Great achievements are rarely solo efforts. Having someone you trust completely, who complements your skills and shares your values, amplifies what's possible. The combination of Henry and George was greater than the sum of their individual capabilities. Finding your George Roberts, whatever field you're in, is one of the most important things you can do.